Well, good afternoon, everybody, and welcome to the Wednesday Lunchtime Drive Through on Wednesday, August the 3rd, 2022. I am your host, Damon King. I'm a certified financial planner professional and wealth management advisor with ChappelWood Financial Services. We are advisors to millionaires and aspiring millionaires. And I'm also the lead instructor for ChappelWood University, which is the educational branch of ChappelWood Financial. We believe very strongly in education. And a big part of the reason we do this 30-minute weekly webinar most weeks is so that we can talk about current events going on with the market, the economy, and just finance and your money in general. And usually I have a dedicated topic that I like to discuss, but from time to time, I like to just open it up to you for questions. I think it's a lot more interesting, it's a lot more fun when you direct the conversation, when you answer or ask questions, things that are on your mind, whether it's related to the market, whether it's related to just retirement in general. Maybe you've got a Social Security question or a Medicare question. So that's what today is all about, is answering your questions. And so I'm going to change the slide here so that you can see, do you have any questions? What questions do you have? What do you want to talk about today? And the way that you can submit your questions down below in the little bar down below, the toolbar, you can use either the chat or you can use the Q&A function to ask your question. I will see it and I will answer it here live during the Wednesday Lunchtime Drive Through. Now, here's one caveat. You might ask me a question that I really don't know the answer to. I don't know everything. And if you do, I will tell you that I don't know the answer to that. And I'll have to go look it up, or I have to go research that a little bit. But to kind of get the ball rolling, now let's talk about some of the elephants in the room that we're still dealing with. Obviously, if you open your July statement yet, if you've gotten your July statement, you may not have gotten it yet. It is just August 3rd. It's going to look a lot better than June. All right, the market was up 9% in the month of July. And so that's good. You know, I've talked with a lot of clients recently who are saying, look, Damon, I'm not panicking. I'm not suggesting that we just sell everything and get out of the market. But man, those monthly statements are really difficult to open. and you know, jokingly, they'll say, I guess I'm just not going to look at them anymore. But your July statement should look much better depending upon how you're invested, whether you're aggressively invested or moderately invested. That will determine how much better that statement looks. But the market does seem like it's a little bit on an upswing. And if you were in the drive-through, if you attended last week, we talked about, are we in a recession? Are we not in a recession? And I gave the arguments for why we are in a recession, why we may not be in a recession, regardless of 2 consecutive quarters of negative GDP. However, one of the things that I said in that, regardless of a recession, is that the market tends to, the decline in the market precedes the recession. The market usually hits a bottom well before the recession has set in, because the market is a prediction, it's a reflection of what we believe about the future. And it would seem that right now, investors are feeling a little more hopeful about the future, which is what we're seeing with the market, why we're seeing this little bit of a rebound. And what could be leading to that hopefulness? Well, I don't know. There could be a few things. Number one, if we already are in a recession, and if 2 consecutive quarters of negative GDP truly does signal a recession, even if it doesn't, in the minds of a lot of people, it does. So if the recession has already happened, and if we're on our way back up, well, then the worst has happened, right? And so for a lot of people, they see that as a sign of, hey, the worst is over. It's time to get back in. Let's see. We do have a question here. Okay, Dan, thank you for your question. So Dan asks a really great question. Do you recommend I bonds, and what are the pros and cons? So Dan, I actually led a drive-through on I bonds. You know what? I wonder if I can. I'll tell you what I'll do. Before we leave here, Dan, I'm pretty sure I uploaded that to our YouTube channel, and I will put the link here in the comments so that you can go to it. Do I recommend I bonds? I'm going to answer that question the way I answer most questions, and it depends. All right, it depends on what you're trying to accomplish. If you are still in a relatively uh, aggressive growth phase of building your wealth, you're still in that accumulation phase, I'm not sure that I bonds are really going to make that big of a deal for you, make that much of a difference for you. If you're still trying to grow your wealth, I bonds aren't really growth mechanisms. They're not growth assets. However, if you are in retirement or you're very near retirement, and now income is more important to you, keeping pace and beating inflation are more important to you, well then yeah, I bonds can play a great role inside of your portfolio. So what are the pros and cons? Well, the pros, obviously, the biggest pro is that they pay a much higher interest rate. In fact, that interest rate is designed to beat the current rate of inflation. Now, for bonds issued through the months of May through October, I'm pretty sure, okay, I have to remember this. The interest rate that they're paying right now is 9.72%. I think that's the interest rate. And that interest rate is a combination of two things. There's a fixed rate, okay, a base fixed rate, which I think is around 2%, plus an inflation adjusted addition. So they take that inflation, and when inflation is high, then that inflation adjustment is higher. When inflation falls, then that inflation adjustment is lower. But the goal of an I bond is to just beat inflation, to generate enough income to help outpace whatever the rate of inflation is at that time. So the biggest advantage to that is beating inflation. Now, another great advantage to an I bond is, like with any government bond, it's largely protected. Okay, it's pretty safe, just like Series EE bonds or HH bonds or whatever those are. Okay, it is a government issued bond, and they're pretty easy to get. All you have to do to purchase I bonds, you can go to treasurydirect.gov and you can set up a free account through the United States Treasury. That's where you're buying these bonds, or that's who you're buying them from. And so you can go to treasurydirect.gov. I walked through all the steps, step by step, in the video that I did. And again, I'll post that link here in just a moment so that you can see how to set up your Treasury Direct account, purchase I bonds. Now remember, you are restricted into how much you can buy. So here's one of the cons. You're restricted into how much you can buy in I bonds. And to buy them through Treasury Direct, you're restricted to $10,000 per year that you can buy in I bonds. The other thing that you need to consider, when inflation goes down, then the interest rate on the bonds that you purchase can be adjusted. So every 6 months, they are adjusted based on whatever the rate of inflation is at that time. So that 9.72 is not necessarily going to be what you're going to get the entire time. It's going to be based on whatever inflation is at that time. Another downside is that you have to own the bond for at least 1 year. All right. So if you want to cash out early, you can, but you have to hold on to it for at least 1 year. And if you cash out of that bond before you've owned it for at least 5 years, then you're going to sacrifice about 3 months of the interest payments that you would have received. So you need to know that going in. There is a little bit of an early out penalty if you get out of those. But that's a great question, Dan. And I go into it a lot more in depth in my presentation. Like I said, I'll share that link here in just a moment. Great question, Dan. We do have another question here from Eddie. Eddie asks, what are your thoughts about saving to buy a vehicle, $70,000 or thereabouts, shortly after retirement in mid-2025? Should I put the full amount plus my 50 plus catch-up provision into my TSP to get the full matching and just withdraw it after retirement? Or should I cut back on my contributions and just stash the cash between now and then? I'm currently putting my contributions into a Roth TSP. Matching funds go into the traditional TSP. Okay, so a lot of different things to unpack here, but basically what Eddie's asking is, look, would you buy a car here in the short term and potentially use future retirement funds to purchase that, or would you save up the cash and then cash flow that when the time comes? I'm always a big fan, Eddie, of saving up the cash for anything that I want, any big ticket purchases. I am very hesitant to use retirement assets to make a big purchase like that. If you were talking about $10,000 or $15,000, okay, that's probably not that big a deal to pull out of your Roth IRA or something like that. $70,000, that could be a big chunk if you're going to pay for that out of pocket. Now, if you've got sufficient other retirement funds and $70,000 honestly isn't going to be that big a deal in terms of your income plan, okay, I don't mind that. And you did mention that it's going to be a Roth. So when you finally quit working, what you're probably going to do is roll your Roth TSP into a Roth IRA, and then you're going to take the traditional TSP and roll that into a traditional IRA. You could certainly take the money from your Roth to pay for the vehicle, and that's going to be tax-free. However, that's also money that you're not going to have later on, tax-free money that you're not going to have later on in retirement to use for cash flow purposes. And the reason I love having Roth money for you later in retirement is because not only will that money be tax-free for you in retirement when you can least afford to pay taxes because you don't have a dedicated paycheck anymore, but those Roth distributions are also going to help lower the percentage of your Social Security that gets taxed. It's also going to potentially help to lower the likelihood that your Medicare Part B and D premiums are going to increase, because both tax on your Social Security and your Medicare Part B and D premiums are based on taxable income. The more taxable income you have, the higher the tax, or the higher the percentage of your Social Security that can be taxed, and the higher your Medicare premiums. Roth distributions do not count towards your adjusted gross income, and therefore they do not count towards taxing your Social Security or increasing your Medicare premiums. So in this case, and this is probably just my conservative nature and my unwillingness to tap retirement accounts too heavily for those big ticket purchases. If it were me, you're giving yourself to 2025, I would try to save up as much of the cash ahead of time as I can. You've got 3 years, 3 years to store up as much cash in your savings as you can. I would rather preserve my retirement accounts and the growth that's going to come along with those for retirement. Now, that's just me. Again, I would want to take a look at all of your assets. And if you've got like $3 million in assets, $70,000 isn't going to make a heck of a lot of difference. Okay, fine. We can do that. But my default answer, Eddie, is I would rather see you save up the cash, or as much of it as you can, to put towards that $70,000 purchase. And then we can decide if there's any gap remaining, how are we going to fund that? So that's my answer to that. You can choose, Eddie, whether or not to take my advice. But that's my answer. Okay. Let's see. Are there any other questions? Let me see if we have any other questions in the chat. We don't have any other questions. So the phone lines are open, ladies and gentlemen. Please submit any question. Today is open mic day. Any question that you want to ask about the world of finance, whether it's you personally, you want to ask a broad question. So Eddie asked a great question about saving up. How would you purchase a car? Would you save up to pay for that? Or would you put money in, take money from retirement accounts later? And right now, instead of saving up the cash, go ahead and just max out your retirement savings now, knowing that you're probably going to tap those to buy the vehicle later. Again, it's a trade-off, but I'm in favor of the cash. And then Dan asked a great question about I-bonds. So I tell you what, since we've got kind of a lull here, I'm going to stop sharing my screen for just a moment, and I'm going to find the link to the YouTube video that I did. So let me see if I can find that for you on I-bonds, and I'm going to post that in the chat so that you can click that link. And here's another thing. If you would like to find past episodes of the Wednesday Lunchtime Drive Through, and maybe you missed an episode, you can actually go to YouTube and search for our channel, Financial Diva. It's all one word. All right. In fact, here, let me go ahead and share the screen with you. Here it is. All right. So this is our YouTube channel, Financial Diva. And when you go there, click on playlists. All right. Click on the playlist button right there, and you will see there's a playlist for the Wednesday Lunchtime Drive Through. And I have a ton of past episodes here. And let's see here. Oh, did I not load the one on I-bonds? You know what, Dan? I may not have done that. Okay. So here's my commitment to you. I will load the video that I did on I-bonds, and I'll put it on our YouTube channel. Give me a couple hours, I'll get it up there. But then here in another few hours, go to YouTube, go to the Financial Diva channel, and click on our playlists. All right. So again, where you're going to go, Financial Diva, click playlists, and right here in the middle, you'll see for the Wednesday Lunchtime Drive Through. You'll click that, and you will see our entire playlist here for the Wednesday Drive Through. Okay, we got another question here. Oh, you're welcome, Dan. You're very welcome. Let's see, what else? Any other questions you have here? Let's see, who all is on today? I know there are some of you that always have a great question to ask. I want to give a quick shout out to all of our wonderful clients who are on the call today. Forrest, it's good to see you again. Jay, it's really good to see you. Hope that you're doing well today. John, good to see you as well. I hope you and Lori are doing well. Kathy, it's really good to see you. Kathy, I'd be interested to know what's going on in the world of gold. Kathy works in the gold world, so she knows a lot more about gold than I do. So I'd be interested to know, is there anything new going on in the world of gold these days? Marty, it's good to see you. Let's see, Susan, how are you doing? Really great to see you, Susan. And then Susie, it's great to see you as well. Wendy is one of the regulars here on the Wednesday Lunchtime Drive Through. So really excited to see all of our wonderful clients here. We got a follow-up question from Eddie. Follow-up. Okay. He says, follow-up. My question was really, should I save the cash and cut back on my current TSP contributions, or save the funds in the TSPG fund for the vehicle? Okay. Now it makes more sense. All right. Thank you, Eddie, for clarifying that. So really what he's asking is, I'm putting money into my TSP. That's the Federal Employee Thrift Savings Plan. That's basically the 401k for federal employees. Should I cut back on my current TSP contributions and save up that cash, or save the funds in the TSP G fund for the vehicle? So the G fund is basically the safe, it's like the cash fund. So you can invest in cash, you can invest in bonds, stocks, international. The G fund is G for government, or government bonds, basically. I'm maxing out my TSP about $28,000 per year before matching funds. So, Eddie, yeah, I probably would do that. I might look at maybe cutting back on the TSP just a little bit to save up the money. I mean, what are we talking about? We're talking about 3 years here. I'd be curious, do you have any other cash already saved up for the vehicle? Do you have any cash saved up towards the $70,000? Because then we could maybe split whatever the remainder is. If you've already got 30,000 saved up, well, then we need to save another 40, right? So we can split that into 3 years. And what does that come out to? A little more than $10,000 a year. I'll call it $12,000 a year. Okay, about 1.3 million in the TSP. I hate to lose out on the growth that you're going to get over time. I'd need to really think about that one, because while I love the idea of saving up the cash, if it's going to mean the difference between putting more money, of course, you're just putting into the G fund right now, and it's not really growing anyway. Yeah, I would probably take some of that money, Eddie, and set it aside in the G fund, because it is, at least the G fund is going to grow at a faster rate than just your cash or money market account. Okay, you're going to get a better rate of return in your G fund than if you just stuck the money in cash. So yeah, I'd probably back off a little bit on putting into the C or the S or the I funds, if that's what you're doing. That's probably what you're doing. and saving a little bit in the G fund, and then using that later on as some cash to cover the cost of the vehicle. Again, depending upon what the world looks like in a few years, I have a lot of clients that have found 0% interest loans to entice people to buy vehicles. Of course, those days may be over in the next few years. Looks like the playlist has not been updated since May 13th. Steve, you may be right. I have been remiss in getting episodes updated. So I tell you what, my commitment to you guys is this. I've got a lot of past episodes that I do need to upload. I thought the I-bonds were in there. So I'm going to get several episodes. It takes me a little while to get those uploaded just because it takes time to upload the videos. But so Steve called me out. And so he's right. I need to get those updated. So I'll get some of those past episodes updated. And then I encourage you to subscribe to our channel. And that way, every time a new episode is uploaded, you'll get that notification. So I will make sure I get that done for you guys because I want you to see what you might have missed. So we answered that one. We answered that one. Thank you very much for that. So Eddie, really good question. Probably would require in real life more thought than what I just gave you here. I would want to talk through some other things. So, and Steve, I'll get that updated. Let's see. Okay, Kathy. So Kathy, she came through for me here. Okay, so I asked her about gold, and here's her answer. Gold demand is still extremely high. Year to date, about 2%. Now, is that a minus 2%? Are you saying year to date gold demand is up 2%? Gold contracts trending up for the fourth quarter. Good time to buy. Return for gold over the past 5 years, 53%. Okay. And, it's not surprising that gold is in high demand right now because gold traditionally is considered a pretty good hedge against inflation, right? And usually against market volatility. But when the market starts to go back up, usually there's an inverse relationship right there. And I get asked all the time, should I down? Okay, down 2%, demand is up. Okay, so return gold price, the value of gold is down 2%, but demand is up. Well, you can buy it cheaper, right? And that's really the same thing with the stock market. A lot of people are concerned about the market. The reality is that the market, just like gold, is on sale right now. And so you can get a lot of really big names right now for a much lower price than typically you might. And so, I have no problem. If you want to buy gold, allocate a portion of your total to gold. If you're looking at any kind of alternative investment, whether it's gold, maybe cryptocurrency, although if you're going to get into crypto, that's much more volatile than gold, okay? Metals, precious metals and jewels can be quite volatile. Well, if they're volatile, Bitcoin is and crypto is, 10x on the volatility scale from that. So if you're going to get into any kind of alternative investment, number one, make sure that asset class meets your investment objectives. Is it doing something for you that you need, whether it's growth, income, maybe some protection, and then make sure that the volatility of that asset class is not going to go outside your own appetite for risk. And then finally, don't allocate too much of your portfolio to any one asset class, okay? So if you've got a bunch of real estate over here that you own, then maybe you don't need a bunch of real estate in your portfolio. If you own a bunch of oil wells already, then maybe you don't need a lot of exposure to energy inside your investment portfolio. If you've already got exposure to gold, you've got gold bullion or coins, Cougarans, whatever, sitting inside your safe, and that constitutes 5% of your total wealth, well, then maybe you don't need to invest in any more gold inside your portfolio. So you've got to take a look at that. But thank you, Kathy, for sharing that information. Gold is always and has always and probably will continue to be a great hedge against high inflation. And speaking of inflation, we should be getting the July inflation numbers here any time now. I'm very curious to see what that number is going to look like. And when you talk about inflation, I would expect that inflation is going to drop here over the next few months, and not necessarily because prices are going to go down. Remember what inflation is. Inflation, when you hear about it today, is a comparison of prices today versus what they were at the same time 1 year ago. The first half of 2021, inflation was still quite low. It wasn't until the second half of 2021 that the numbers really started to go up. Not surprisingly, when we got into the, you know what, ladies and gentlemen, if you could bear with me, I need to go open the door for someone. I'm going to be right back. I wouldn't do this ordinarily, but I'm the only one here. Just one moment. I'll be right back. All right, ladies and gentlemen, I'm back. So thank you for bearing with me. Sometimes at lunch, I'm the only one here, and the door was locked because there's nobody else here. All right, but inflation. So it's not surprising that inflation in the first half of the year was so high, because prices right now compared to the same time last year, much higher, right? But now we're starting to get into the second half of 2022, and those inflation numbers are going to be, or those prices are going to be compared to higher prices in the second half of 2021. What that means is, if I'm comparing August of 2022 to August of 2021, the variation in those prices is going to be lower, more than likely, than the variation between April of this year to April of last year. Does that make sense? So we're likely going to see inflation come down simply because we're comparing prices this year to higher prices at the same time last year. Then you throw into that mix the fact that the supply chain is beginning to ease. We are starting to see some of the supply chain issues ease just a little bit. Regardless of inflation, though, consumer demand continues to be strong. Consumer spending continues to be strong. Now, here's an interesting point, and I'll leave you with this, and if we've got any other questions, I'd much rather answer your questions than hear myself talk here, but consumer sentiment is in the toilet right now. All right, so I just saw from JP Morgan, and really from the University of Michigan, they're the ones that produce the consumer sentiment report each month. And in the month of July, consumer sentiment was at one of the lowest points that we have seen in the last 20 years. All right, you got to go back to kind of the mid 2000s, well, the 2008 certainly. But what's interesting about that? Okay, so when you look at if consumer sentiment is at a high point, and the last high point we saw for consumer sentiment was right before COVID hit. All right, right before COVID hit, first part of 2020. Over the next 12 months, the average return typically from a high point in the market, from a high point to 12 months later, is 4%. Guess what the average return over a 12-month period when consumer sentiment hits a low point like we're at right now? 25% in the S&P 500. From a low point to 12 months later, the average return, a low point in consumer sentiment, the average return in the S&P 500 is 25%. Now, I have no idea if we are at the low point for consumer sentiment, but it's really low. People are spending more money, but they feel really rotten about doing it, I guess. I don't know. I don't know how to translate that, but it's kind of interesting that even though we feel rotten right now, generally speaking, over the next 12 months from that low point, the market tends to perform really well. Are we turning a corner? In some ways, yes, but I don't think we have enough consistent data to truly make a determination on that. We have been saying all year long that we expect the third quarter of this year, which now we're in the middle of it, we expect that to be a turning point for the market. So far, we're seeing that. We don't have enough information to really call a trend yet. So the jury's still out, and we'll take it while we can get it, right? All right. It's just after 1, so I want to thank you very much for joining us today on the Wednesday Lunchtime Drive Through. I will get that playlist updated so that if you want to go back and read or watch any of these episodes, we'll get that updated for you so that you can go back and watch as many of those as possible. So thank you so much for your time today. Hope that you enjoyed this conversation, had some great questions. I want to thank all of our people that ask questions. And of course, always want to say thank you to the wonderful clients, the members of the ChappelWood family. We appreciate you more than you know. And we do not take it lightly that you place faith in us to take this journey with you. So thank you so much. Have a safe rest of your day. Enjoy the rest of your week. And we'll see you next time on the Wednesday Lunchtime Drive Through. Bye-bye.